Good morning, and welcome to the Central Bank's webinar on the New Insurance Act and You. I am Michelle Melville of the External Relations Department, and I will be your moderator for today's session. Firstly, I would like to acknowledge the wide range of participants in today's webinar. We have the major stakeholders in the insurance industry, the media, representatives from the other financial and services sectors, our regional counterparts, academia, and the general public. Special welcome to those of you following the webinar via live stream on our Facebook and YouTube and the bank's website. Note that the presentation slides are available via the bank's website, so you can access these and follow along. Our objective this morning is to introduce you to the main characteristics of the recently proclaimed Insurance Act. This morning, we have a 30-minute presentation by Mr. Patrick Solomon, Inspector of Financial Institutions, Ms. Natalie Rupchansing, Manager, Insurance Supervision, and Mr. Naveen Lala, Manager of Pensions and Intermediaries, following which we will have a question and answer segment. We hope you find the presentation informative and engaging. I now invite Mr. Patrick Solomon to begin the presentation. Mr. Solomon.
Thank you, Michelle. Good morning. As it is still early in the new year, I wish each and every one of you great success in the new normal environment. This morning, we will share with you some key aspects of the Insurance Act, which we refer to as the New Insurance Act, that became effective from the 1st of January 2021, and also highlight significant areas that were not provided for under the previous legislation, the Insurance Act of 1980. It has been a long and arduous journey to reach this point, and I think that it is important to share with you today and acknowledge the tremendous efforts that brought us to the enactment of the New Insurance Act. It is indeed a long time coming. Let us look at the chronology of actual events that brought us to this point. In May 2004, the central bank assumed the responsibility for the regulation of the insurance industry. With some sense of urgency, the central bank, with the assistance of a consultant from the IMF, began to review the provisions of the old Insurance Act. In 2008, the financial crisis exposed gaps in the old legislation, and this was demonstrated in the collapse and ongoing resolution of issues with CLICO. Specific amendments were fast-tracked in 2009. In 2011, the central bank drafted a policy proposal document for the New Insurance Act. After 3 failed bills and 2 further years of extensive scrutiny by the Joint Select Committees appointed by Parliament between 2013 and 2017, the Insurance Act of 2018 was passed by Parliament. The Insurance Amendment Act 2020 was passed in both houses of Parliament in 2020. The overhaul of the legislation was informed by a number of considerations, included but not limited to the insurance core principles, which are minimum standards for effective supervision and are developed by the International Association of Insurance Supervisors, practices and emerging issues in the local and wider financial market, findings in the IMF World Bank Financial Sector Program missions in 2005 and 2010, which included a detailed insurance core principle assessment, extensive consultation with stakeholders in the insurance industry, which included written submission and quantity impact surveys. And the recommendations made by the Joint Select Committees appointed by Parliament in 2013, 2015, and 2017. After all this work, the Insurance Act of 2018 was proclaimed from January 1st, 2020. At this point, I wish to extend my sincere gratitude to our past inspectors of financial institutions who were dedicated and passionate in their efforts to bring this legislation to reality. I speak of Mr. Henry Jeffers, Ms. Catherine Kumar, Ms. Wendy Husing, Mr. Carl Hiralal, and Mrs. Michelle Chongtai Bell. We know that they share in our sense of accomplishment in achieving this significant milestone for the country. The primary objective of the central bank under the new act in respect of registrants is to maintain confidence in and to promote the soundness and stability of the financial system in Trinidad and Tobago. Ladies and gentlemen, the strength of our regulatory framework is critical to the success of our financial institutions and by extension, the financial system. A modern insurance industry requires modern legislation for its continued relevance in satisfying its stakeholders' mandate. It is necessary for the regulator to have sound legislation in order to discharge his mandate, but this alone will not guarantee a sound insurance industry. What is also required is a public-private collaboration and continuous communication to ensure the seamless implementation of this new Insurance Act. The new act facilitates the central bank in its promotion of an efficient, fair, and transparent insurance market and financial stability of the sector. I would like to emphasize that I really see the relationship between the central bank as regulator and all these stakeholders in the insurance industry as one of close collaboration, working together towards a common goal of increasing and further strengthening public confidence in the insurance sector specifically. Our expectation is that the insurance companies and the intermediaries will comply with the regulator, operate in a safe and sound manner, and treat policyholders and prospective policyholders fairly. At the end of the day, we want robust legislation to enable the financial stability of the sector. What are some of the major enhancements to the legislation? Let's look at the diagram on this slide. It shows the enhanced powers and tools of the new act and regulations facilitate and support specific concepts and principles. And my colleagues and I will now share these enhancements with you in a little more detail. I will now take you through the corporate governance requirements that are applicable to all registrants. What is corporate governance? Corporate governance is a system by which companies are directed and controlled to achieve its objectives. The enhanced requirements were structured to ensure key elements exist to provide a strong corporate governance framework in the financial institutions. As such, the new Insurance Act has an entire section, Part D, Section 65 to 81, dealing with corporate governance. These requirements are the minimum requirements to set proper corporate governance framework and are by no means an exhaustive list. Enhanced corporate governance is a critical pillar of financial stability, and insurers must continually cultivate transparency, prudent management, and the protection of policyholders' interests. The new act requires the insurer to establish a culture for high internal standards in the governance framework, and I will now highlight a few of these. Again, you could look at the act. The promotion of independence and objectivity in the oversight function. The Act now requires the establishment of an audit committee which must have at least 2 independent directors. This is now a statutory requirement, whereas it was not mandated in the previous Act. It must be noted that overall, a significant majority of insurers do have audit committees in place. The independent directors will enhance the objectivity in decision-making and governance. The new act also stipulates the minimum duties of the audit committee. Segregation of duties, which also aid objectivity, is required in some functions. For example, the appointed actuary cannot be the CEO or CFO. The independence of the auditor is also critical, and the new act stipulates the minimum criteria to ensure independence of the auditor. Another high standard that must be encouraged is the need for defined responsibilities and accountabilities related to risk management. The new act ensures that the tone is set at the top in order to establish a strong risk management framework, and requires that directors and management certify their responsibility for and satisfaction with the adequacy of internal controls, information, and risk management system, compliance with the Act, regulations, guidelines, and the adequacy of procedures for claim settlements. This is, in particular, an example of how safeguarding policyholders' interests and market conduct is integrated into corporate governance requirement. Transparency and integrity standards are also required in good governance framework, and this is encouraged in the requirements of the new act. For example, the prohibition of directors from voting on contracts for which they have a conflict of interest, the obligation of directors to notify the central bank of any adverse material effects of which they become aware, and the statutory requirement to appoint an internal auditor and an actuary. Prudent management is another important element in the governance framework, and the new act supports this in many ways. For example, the compensation package structure are critical in preventing a corporate culture where short-term risky behavior is rewarded. Boards are now required to establish procedures for remuneration, disallow payments of bonuses where an insurer doesn't meet the minimum capital requirements, and there are restrictions on the payment of dividends when the insurer is in financial difficulty. The central bank must ensure individuals and/or entities responsible for the oversight of the operations have the appropriate experience, knowledge, ethics, and integrity. For example, persons are debarred from being directors and officers unless approved by the central bank. Such examples include bankrupt persons involved in the management of a company that was insolvent in the last 10 years. The fit and proper assessment of certain individuals are now included in the new act. Previously, this was not expressly stated. I encourage you to take some time to review Schedule 5 in the new act, which outlines the fit and proper requirements. It is very comprehensive, and it gives an idea of the significance of the high standards of integrity and probity required in the financial sector. There are fit and proper assessment requirements now for directors, managers, auditors, actuaries. In addition to the assessment of individual directors, the composition of the board must collectively possess the relevant skill set. Further, entities themselves are required to meet the fit and proper requirement, as the new act requires that entities, insurers, brokers, agents must conduct business in a prudent manner to safeguard policyholders' interests and to manage inherent risk. A noteworthy aspect is the assessment of individual considers a wide range of factors. Any evidence or business practice that is deceitful or oppressive, whether it is unlawful or not, and whether the individual will engage in practices that can cast doubt on soundness of his or her judgment. There is so much more in terms of corporate governance. I need to end at this point, and I now hand you over to Natalie, who will speak about stronger regulatory powers and tools for the central bank in the new Insurance Act. Natalie?
Thank you, Inspector. Good morning to everyone in Trinidad and Tobago, to our viewers from the Caribbean, Canada, America, and Europe. Thank you for joining us this morning. we will highlight the importance of the stronger regulatory powers and tools for the central bank. Financial stability also requires an independent regulator with adequate and effective powers to achieve its objectives. Over the years, the bank had to rely heavily on moral suasion because of the lack of adequate powers in the old act to be able to effectively supervise the industry. In many instances, we had a cooperation of the insurers, but in a few instances, we did not, and the alternative measures were so time-consuming, which allowed the issues to continue in the interim. The enhanced powers and tools now allow us to effectively administer the new act. Following, we will highlight some of the new powers. The inspector referred to some in his talk on corporate governance, and you will hear some more in respect of preserving the integrity of the financial sector, safeguarding policyholders' interests and market conduct. The new act enhances the powers of the central bank and the inspector of financial institutions to allow them to effectively intervene in insurers' affairs where necessary, through compliance directions or through court proceedings, and to monitor and examine the affairs of insurers in order to identify risks and take regulatory action to address unsafe and unsound conduct. Previously, there was a narrow scope for assessing risks or exposures in an institution, and consideration of contagion risks was based on a tunnel vision approach, as we were only able to inspect the insurer's records and had limited access to other related institutions to determine exposures. In the new act, our examination powers include to conduct consolidated supervision of all companies in a financial group and/or to restructure the group. The bank can require restructure of the group to facilitate consolidated supervision of all the financial entities within the group, or, for example, where a member of the group is insolvent and it appears that it is a risk to the insurer or to the financial holding company, the bank can require that insolvent company to increase its share capital or that the part of the business is transferred and/or disposed of. The bank also has powers to request information from past or present directors, actuaries, or shareholders, and even to examine records of educational institutions to verify continuing professional development returns for intermediaries. We should note that failure to comply with a request is an offense. The new act introduces measures to deal with unsafe or unsound practices. These include restrict transactions with any parties or other measures that are needed to safeguard policyholders' interests. Note that in the previous slide, I mentioned that failure by an individual to provide information requested by the bank is an offense, and that the bank can restrict transactions with such individuals if policyholders are at risk. The bank can direct disposal of shares where the shareholder is no longer fit and proper, or his holding of the shares is prejudicial to the interests of policyholders. Other measures include direct insurers and/or the parent company to increase capital and liquidity levels, and direct any registrant to comply with guidelines issued. And another example is where the bank can deem a person a connected party if the relationship may be a conflict or a regulatory risk. In addition to the powers of the bank, the central bank also has obligations with which it must comply, which include intervention action. Which include intervention action in an insurer where its regulatory capital falls to 70% or less. The central bank is mandated to intervene and take necessary actions. The bank has no discretion on this. Also, where there are no reasonable grounds to believe the situation can be rectified, the order to wind up must be issued. If the bank has evidence that the auditor or actuary failed to perform their duties, committed misconduct, or is incompetent, the bank is mandated to report the matter to professional associations. In addition to the powers to regulate insurers, there are also powers to aid effective administration of the Act. For example, administrative fines can be issued for specified offenses under the new Act. There are about 88 offenses for which administrative fines can be issued. There were previously no administrative fines in the old Act, and prescribed fines were based on summary conviction. To make matters worse, these prescribed fines were insignificant. The criminal penalty for a breach of the old act was a maximum fine of $5,000. However, under the new act, criminal penalties range from $30,000 to $10 million. The administrative fines are referenced in Schedule 6 of the new Insurance Act, and I encourage you to review these administrative fines. Another example of powers to support the effective administration of the Act is the authority to allow extensions of prescribed deadlines in the event of natural or unavoidable catastrophes. This allows the bank greater regulatory discretion in times of emergencies by allowing extensions for deadlines stipulated in the Act. This was not contemplated under the old Act and resulted in many challenges. Now, this flexibility to the bank is certainly applicable at the times we are facing. We will now look at enhancement to preserve financial integrity. You have heard previously of requirements designed to promote sound corporate governance and risk management practices and safeguarding policyholders' interests. The central bank is also responsible for ensuring that the financial sector is stable, well-functioning, and promotes public confidence. Financial stability requires prudential measures as well as accurate, timely, and relevant regulatory reporting. Together, these factors will preserve the integrity and soundness of the insurance sector. We will now highlight just a few of the measures in the new Act aimed to preserve the financial integrity of the sector. There is enhanced regulatory reporting. Insurers' financial statements are now consistent with the International Financial Reporting Standards and which must now be published in daily newspapers. Previously, there existed what is called the Insurance Act accounts, which were not consistent with the IFRS standards and can only be used for regulatory monitoring, but not for assessing financial performance and comparability from an economic perspective. Publications of the financials allow greater transparency of the sector, which lends itself to integrity. There is now timely reporting requirement, which is 3 months after the fiscal year end versus the previous act, which was 6 months from annual returns and 9 months for actuarial reports. That disparity was really deficient. Insurers are now required to submit various quarterly data, for example, data on the insurer's financial position, reports on large credit exposures and connected parties exposures, reports on shareholding of insurers, and capital adequacy positions. Let us now look at some prudential measures included to support the financial integrity of the sector. There's now a requirement for general insurers to have an appointed actuary. Claims reserving techniques of general insurers have always posed a challenge in the sector. Now, general insurers have 3 years within which to appoint an actuary to certify the valuation of the reserves and apply the actuarial standards, which will enhance the reliability of the reserves stated on their balance sheet. Directors, actuaries, and auditors are obligated to report on any matters that have adverse material effects on the financial conditions of the insurer. There are restrictions on insurers engaging in business other than insurance. This mitigates any over or understatement of the real strength of the balance sheet and the financial assets supporting the insurance business, as well as protects against exposures to linkages in non-insurance sectors. And this last example is for the policyholders, where all insurers are required to submit all unclaimed monies on policies to the central bank. This now is also a requirement for general insurers as well as long-term insurers, and they have to publish a statement of the unclaimed monies. This gives reassurance to the policyholders or beneficiaries that they can still claim funds to which they became legally entitled but did not recover at the time. So that was only a few key points on preserving the integrity of the sector. We now go to Naveen for the last leg of our presentation.
Okay, thank you, Natalie, and good morning, everyone. Now, the inspector gave us the foundation of the governance philosophy that we expect market practitioners to follow. Natalie introduced you to enhanced regulatory powers in the new law, as well as how the Act aids in preserving the integrity of the financial system. I would like to introduce you to some technical measures that we have introduced in the new law that are specifically targeted to safeguard policyholder funds. Now, the old law has some very basic metrics in setting buffers to protect policyholders. For example, there were very low minimum stated capital levels. There was a statutory fund and a statutory deposit, and a margin of solvency that was a function of volume of sales. Whilst these metrics may have been very appropriate in the 1980s and 90s, they actually have no place in a 2021 financial environment. The new law not only significantly increases the minimum stated capital, it also introduces something known as risk-based capital. So what is risk-based capital, you may ask? Firstly, capital is a buffer that the company establishes for unforeseen circumstances. Risk-based capital basically tells the company, the more risk you take, the bigger the buffer you need to set up. Now, the law actually goes one step further in that it asks the company to set a margin even on top of that. So in other words, to set up an even bigger buffer. The objective of this is really aimed at safeguarding the promise made by the company to you, the policyholder. A company with a very strong capital position has a higher probability of paying you, the customer. So in addition to the enhanced capital, the new law requires companies to do something known as stress testing. So what is stress testing? This is basically a test of the strength of the balance sheet of the company in different scenarios. Some of these scenarios may range from plausible scenarios to situations where you have macroeconomic shocks to a catastrophe. The main objective is to ensure that the company's finances are strong enough to withstand various challenging realities. The stronger the balance sheet, the higher the probability that the company will be able to honor your legitimate claim. The new law now limits related party transactions. So without going into too much detail, when you analyze failures of financial entities throughout the world, one of the recurring themes are high volume of related party transactions. The new law places significant limits on these practices, which in turn reduces the likelihood of abuse by a group with insurance monies. This limitation also promotes increased transparency and confidence. The new Insurance Act also introduces a common methodology to value insurance liabilities. Now, what is this? Basically, actuaries compute the likely payout to you, the customer. In aggregate, that amount is known as the insurance liability. But in the past, companies have been varied in how they approach this. Some companies' approaches were very conservative, while others were not. The new law introduces a common approach and a minimum level of conservatism in determining how much money is put aside to honor the company's promise to you. Finally, I would like to quickly touch on several other enhancements in terms of key risk areas. The central bank will now have the ability to perform enhanced supervision on reinsurance arrangements in the sector. Basically, reinsurance is when an insurance company buys another layer of insurance, particularly for catastrophes. For example, if a hurricane hits Trinidad, the accumulated losses may be too large for a single insurance company to pay. To mitigate this risk, the insurance company will buy additional insurance from an international reinsurance company. It is imperative that these arrangements are robust, that they make sense, and they are with financially strong international reinsurance companies. To further protect against the catastrophe risk, insurance companies are now required to maintain a special reserve. Finally, I would like to mention that the new legislation has strict rules in relation to how monies are remitted to the insurance company. This is important. This is an important measure as it minimizes the probability that an intermediary will hold onto your funds and not pay it over to the insurance company on time. I would now like to change gears a bit and speak on market conduct. Now, at the end of the day, the true test of a well-functioning regulatory system is not only centered around financial stability, but how that system translates into the everyday experience for you, the consuming public. As such, the Insurance Act 2018 pays particular attention to introduce elements that will promote the standards of market conduct. In the context of today's discussion, these enhanced standards communicate our expectation in relation to practices, policies, and procedures to facilitate a sustainable, fair, and sound financial environment for you, the customer. And this is a trend we observe worldwide. Elements introduced in the new law are centered around various fundamental pillars. So for today's session, I would like to focus on 4 of these pillars, namely transparency and clear marketing, product suitability, professional standards, and customer redress. So in relation to transparency and clear marketing, the new law introduces several standards to ensure that sales and marketing material are fair, accurate, and most importantly, not misleading. Examples of these standards range from the very simple, for example, ensuring that the size of the font in both the marketing material and the policy contracts are of a reasonable size and clear, to the more complex situation where we want to ensure that key information is present and that information is fully supported and verifiable. The objective of this is to ensure that the customer has adequate information in a clear and easily understandable manner in order to make an informed decision. And we've actually issued a guideline which articulates our expectations. It's known as the Post-Sales Communication Guideline, and the link is on our website on the slide. The next pillar speaks to product suitability. Now, the new Insurance Act introduces the requirement for the agent, broker, salesperson that they must have enough information to understand the needs of the customer. The product being offered to that person must be aligned to the customer's profile, the customer's objectives, and the customer's needs. In other words, we want to minimize the probability and occurrence of mis-selling. Hopefully, if all goes well, we will not see a case where a deferred annuity is sold to an 80-year-old. Next, the Insurance Act introduces professional standards for market practitioners. These standards include the new fit and proper requirements mentioned by the inspector in his discourse on corporate governance. Standards also include enhanced educational requirements for insurance intermediaries. This is in particular reference to the fact that all insurance intermediaries must obtain at least 12 hours of continuous professional development per annum in order to maintain their license. The main objective of this pillar is to ensure that market advisors have the requisite technical knowledge to properly advise you, the customer. So while there are many other market conduct elements that have been introduced in the new Insurance Act, I would like to end by speaking about the customer redress pillar. The new law requires insurers to have a documented and operational customer complaint process. In addition, it is now mandatory for insurance companies to join an alternate dispute resolution scheme. So in the event that the customer does not get a resolution for his or her complaint at the company, he or she can refer the matter to the alternate dispute resolution scheme for possible resolution. As the above may allude, The market conduct standards being introduced into the new act are very, very focused on fair treatment and fair treatment to you, the customer. So on that note, I would now like to hand it over to the inspector to highlight the key milestones to date.
Thank you, Naveen. Some of the key milestones, we try to summarize it for you in the final slide, where we speak about transition of foreign insurance company, and you give you a timeline for compliance. So they have 18 months. The purpose is to ensure that the foreign insurers bring all their business locally and it's controlled locally. We have issues of minimum regulatory capital. You have a 5-year period to come into full compliance. We have new reporting regime that starts from 2021 to 2022. The commencement of continuing professional development hours, as Naveen spoke about, market conduct and suitability issues, the transition of individual agents and brokers registered under the old Act to become corporate entities by December 31st, 2021. And we have full transition to the new capital requirements for brokers by December 31st, 2023. At this point, I would thank the other two presenters, and I will pass you on to Michelle to conduct the other aspects of the webinar.
Thank you, Mr. Solomon, Ms. Rupchansing, and Mr. Lala. Together, you have presented a comprehensive and informative overview of the new Insurance Act. Now, on to the exciting part, the question and answer segment. We understand that this is new and there may be many questions, and we would like to hear from as many of you as possible this morning. So we ask that you follow these simple guidelines. To our webinar participants, please use the raise hand icon to indicate that you have a question. When acknowledged, please state your name and the organization you represent before addressing the panel. You can also opt to type your question in the chat, and I will then read the question to the panel. Once your question is addressed, please remove the raise hand icon. To those of you following the stream, you may send us your questions via Facebook. So let's take the first question. We have some coming in via the chat from Mr. Ulrich Miller. Will all claims made on unpaid claims be now administered by central bank, and what will be the process?
Unclaimed monies, no. Could you repeat the question, please?
Sure. Will all claims made on unpaid claims be now administered by the central bank, and what will be the process?
No, the insurance companies is responsible for administering its own claims. If they have a payment on a claim to be made to the policyholder and the policyholder has not collected the funds, they are required to admit those unclaimed monies to the central bank. They will submit a list of details of the claim, the claimant or the beneficiary that is entitled to the funds, and they will submit that information to the bank. And in the event that the person comes forward, the insurance company will be required to advise the bank of the details that they have confirmed the policyholder is they will confirm that the claimant or the beneficiary is the correct person to pay the money over to, and the central bank will return the funds to the insurance company to be paid to the policyholder or to the beneficiary.
Thank you. Thank you, Natalie.
Something to that, in the sense that the information or the process is in Section 197 of the Insurance Act, which speaks to unclaimed money process after publication of an advertisement and the payment of the money into the consolidated fund. The policyholders must make a claim on the insurers. The insurers has to satisfy itself that the policyholders is entitled to the money, and the insurer requests the central bank to pay the money to the policyholders. The central bank will release the money to the insurers. to pay the policyholders. So this process is already contained in the Act. So you could refer to Section 197 of the Insurance Act for further guidance on this matter.
Thank you, Mr. Solomon. We have a question. I acknowledge Wayne Das.
Hi, good morning. Thank you for the excellent presentations by the panel. My question is based on the new risk-based capital rules. Does the central bank foresee any potential undercapitalization issues with insurance companies in Trinidad and operating in Trinidad and Tobago? Over the coming years. I know there's a 5-year window to meet the ratios, but based on say existing books of business, do you foresee any potential undercapitalization problems with insurance companies? Thank you.
Okay, there are no significant undercapitalized companies that will exist under the new act. And as you mentioned, they do have a transition period. The central bank will be working with the companies on a case-by-case basis in those instances. And the companies are required to submit a plan as to how they're going to come into compliance with the capital requirements. And we will be following up with the companies in terms of their fulfillment of the plan and how they're going to implement the plan. Of course, it has to be a reasonable plan and the timelines has to be reasonable within the transition period. But as of now, there are no significant issues with respect to any of the companies maintaining or coming into compliance with the capital requirements.
Thank you, Natalie.
I would like to add to that. Just to put it into context, I mean, this is a discussion that we've been having with the companies for many years now. We would have done, as Natalie indicated in her part of the presentation, quantitative impact studies in relation to the new capital requirements. So the companies are very much aware of how the calculation is done, the requirements, and their position in relation to the new requirements.
What I could add as well is that your risk-based capital is the minimum capital. Most of the companies have more than the minimum at the point in time.
Okay, so thank you, panel. We have a question. When would Section 184 and 185 be proclaimed?
Essentially, it's up to government to determine the proclamation of those sections in liaising with the president. So at this point in time, we cannot give a specific time frame.
Okay, questions are coming in fast and furious. Can the appointed actuary be an actuary in the company or group, not being the CEO or CFO?
So the Act does not restrict the appointed actuary being the in-house actuary. However, the Act requires that there is no situation in which an actuary's duty to the insurer or statutory duties comes into conflict with the actuary's personal interests or with the duties of the actuary to another party.
Okay, as it relates to the ADR scheme, would any guideline be published giving guidance as to what the scheme should entail or what the central bank is looking for?
So the short answer to that is yes. What we have been doing with all the things that we have been introducing in terms of this new act is we issue either a circular letter articulating the various expectations and requirements or a guideline? So the answer is yes.
Sure. Can you provide more details on the professional development requirements? The 12 hours mentioned, how is it accredited, or what training would be approved for this purpose?
Okay, so the Act requires that all intermediaries, and that is salespersons, adjusters, brokers, and agents, must obtain at least 12 continuous professional development hours per year. Now, there is an entity called an Approved Educational Institute within the Insurance Act, and at this time, that body is the Trinidad and Tobago Insurance Institute, and they will be the administrators of the CPD regime. So from an operational point of view, the central bank will rely on the reporting from the TTII in relation to if an agent, broker, adjuster, or salesperson meets the requirements. The industry, meaning the various stakeholder groups, the brokers, adjusters, and salespersons, their stakeholder groups have issued or discussing a draft guideline which details what are the expectations in relation to the types of courses that will qualify, etc. And the central bank has representation on the Council of Trustees of the TTII, so we are also part of that discussion in relation to those expectations. But once those things are fleshed out, again, as my previous answer highlighted, we will be communicating to the industry in relation to those expectations.
Thank you. We have a question here from Mr. Akbar. The capital adequacy measure is still static or formulaic, does not give insight for prudent management. What about ORSA?
The risk-based capital is the minimum requirements for the capital adequacy. The companies are required to submit their own risk assessment. As part of their risk management framework, they would be conducting their own internal risk assessments, which is the ORSA. But the capital adequacy ratio, though, the calculations, it is not static. It depends on the risk that the company take on. So it's changing as long as the company takes on more risk or they invest in any sort of investments that are high risk, the capital requirements are going to increase in accordance with those risks.
Okay. So I would like to add to that. So in my section of the presentation, I mentioned the whole concept of stress testing. Now, associated with that requirement is something called a financial condition report, which is really used as a management tool where the company will need to utilize the different scenarios and stress testing, which is more of a forward-looking metric, and then formulate management strategies in order to address. So whilst the capital adequacy is just one input in terms of the whole management framework in relation to assessing the risk today, but also how does that risk manifest itself going forward.
What I could add as well, when you look at capital adequacy, you start with, as you said, a static measure. Currently, capital is in the vicinity of 1 and 3 million for a general and a life company. But the new act, we're increasing this to 50 million. Also, what we call that is deterministic type of capital. We are now going to the risk-based capital, which is the minimum standards at this point in time. Globally, others have gone to, as the question was stated to the OSA, right, which is the own risk self-assessment, which is dynamic. So over time, we will be updating our risk-based framework. So currently, we are taking it in steps. Currently, a static into a more dynamic or risk-based, and then we'll eventually move to some of the international best practice, which is own risk self-assessment. You have a similar sort of situation under the banking group, right? We say called ICAP. But yes, I understand the question. So we are taking it in steps from an outdated capital requirement to risk-based, and then we will go into own risk, which you described as this dynamic form of determining your own capital.
Thank you, panel. We have a question from Mr. Richard Young. Mr. Young, I acknowledge you. You may ask your question, and you can turn your camera on if you can. Mr. Young, are you still there? Okay, we'll come back to Mr. Young. We have a question from Mr. Hiralal. Mr. Hiralal, I acknowledge.
Hello, good morning. Congratulations to Central Bank for this milestone. This is indeed important. My question has to do with capital. Will the central bank be able to make changes to the capital rules on its own through discussions with the industry, or do all changes to the capital rules have to go through the parliament?
We have to go, Mr. Hiralal. Thanks for calling in. All regulations are made by the minister, so this will be no different to what we have. So we have, at this point in time, the increase in the static capital, the increase in risk-based capital. If we have to go to the other sections, we need to make a justification, and these regulations will be done by Parliament, although the inspector has the discretion to ask for additional capital based on risk, but this is only formula driven and it cannot be changed. So if we need to go to a fundamentally different approach, it has to be done via regulation by the minister.
Okay, thanks. Just as a follow-up question, is there any contemplation of turning the capital rules, which are now embedded in the Act, into a guideline, and that would make it more flexible for the industry and the central bank to make these changes, because capital rules are so dynamic today?
Yes, that may be a possibility. However, I'll have to check with the legal to figure out what is the best approach to achieve this dynamic section. But under Section 184 of the Parliament, they have to debate it and discuss it. And these regulations may have constitutional implications that we have to give thought to before we issue these sort of guidelines. In other words, a lot of these things, as you're aware, depends on the regulation. The law hasn't changed in that respect. We have to do it via regulations because there will be, as you say, constitutional implications that we need to consider before we change the format.
Okay, thank you, Mr. Sullivan. We have a question from Mr. Anthony Wilson. Mr. Wilson, you may ask your question to the panel.
Morning. Morning.
Good morning.
Morning. I have two questions. One, will the new capital requirements increase the cost of insurance for consumers of insurance? Should I ask the second question now?
Okay, ask the second question as well.
Right. So the second question is on the issue of conflicts of interest. Can the inspector address the appointment of the actuary at a company controlled by the central bank?
Okay, I'll take a stab at the first question about increasing fees. With respect to the structure of fees for intermediaries, we always look at the requirements to pay annual fees, and this is included in Part B of our new Insurance Act. But insurance fees is a combination of international experience. If you look at the international market, we recognize that reinsurance rates are increasing. And since reinsurance rates are increasing in order to cover the losses, and the fact that our local companies cede part of their premiums to the foreign companies, it is only natural that if the fees are increasing internationally, we will have some increase locally. So it's not necessarily associated with the Insurance Act. Fees are determined by the loss events. And for the climate changes that we are seeing occurring, we recognize that the frequency, the intensity of these natural disasters are coming and having an effect on the Caribbean region. So the Caribbean region is looked at as a whole from the insurers. So fees are increasing in the Caribbean in those jurisdictions that suffer loss, but it is also assisting, it is also increasing in other jurisdictions that provide insurance. Because remember, the purpose of the fees is that the fortunate help the unfortunate. So we have to contribute to maintain this pool. So I am saying that the increase is not related necessarily to the Insurance Act, but it is a global phenomena, and we are part of a global village, and we have to contribute to that.
Thank you, Mr. Solomon.
Yes, a second. Huh? Right. With respect to CLICO, in this forum, we can't speak about specific insurers. But what we can say is that actuaries are required to be fit and proper and must be approved by the central bank. Consequently, the central bank could object to the appointment of an actuary. So we have to understand the situation, understand the roles and the responsibilities, and whether these will relate to any conflict. And once we recognize a conflict, we will take the appropriate action to deal with it.
Okay, thank you, Mr. Solomon. We have a question coming in from Ms. Gina Samaru.
Yes.
Given the alternative dispute resolution scheme being established under the new act, is it envisioned by the central bank that the OFSO will continue in the long term, or will it be dissolved?
Okay, what I could say is that it depends on the roles and responsibilities of the OFSO, as well as the alternative dispute resolution process. Remember, they may perform similar roles, but there are certain areas that limit what the OFSO can do, as well as the dispute resolution. So we are still evaluating. We have made no decision as yet, and the bank have been having discussions with both the OFSO as well as dispute resolution providers to determine what are the areas of demarcation and how both schemes could coexist in the emerging environment.
Okay, thank you. A question from Ms. Sandra Ramjit. With the advent of the new normal, there are a lot of social media insurance advertisements from agents stating that everyone can access a certain sum assured at a particular premium with no medicals. What is the procedure on this type of marketing?
Okay, so To attempt to answer this question, I just want to go back to some first principles in relation to expectations in the new act as it relates to insurance intermediaries. First and foremost, independent of the mechanism of communicating, that individual needs to be a registered intermediary. So, and on our website, we do publish on a quarterly basis all registered agents, brokers, adjusters, and salespersons. So if, independent if someone speaks to you on the phone or you access them through social media, it is important to make sure that they are registered intermediary, first and foremost. In relation to the question about if what is being advertised is actually if it's real or not, again, an intermediary works on behalf or with an insurance company. So you need to ask the specific questions in relation to what do these things mean. There are some insurance products in relation to very, very low sum insureds that may not require medical. But again, it's not a one answer fits all. It all depends on the type of insurance product. Yep.
Thank you, Mr. Lala. Melissa Suraj would like to know, regarding CPD, is there a list of accepted training courses which can be used?
So the short answer is no. We are working, or the industry is working assiduously in terms of developing those guidelines. So I could disclose the types of questions I've been asked. Will an hour of training equate to an hour of CPD? Will training in basic things like Excel and stuff like that be an hour of CPD? So those are the types of discussions that are going on. So to answer the person's question, there is no informed list at this time, but TTII in relation and with the conjunction of the various stakeholder groups are working at this time to structure those guidelines.
Thank you, Mr. Lala. Samantha Saw, hope I pronounced that correctly. She asks, Section 87, can you highlight some of the requirements to seek approval for permissible real estate?
Some of the requirements would be the company that is conducting the real estate, it has to be a subsidiary that is 100% owned by the insurance company. They have to apply to the central bank under Section 30 to get approval for that line of business. So once they apply, we will consider the applications and determine what other information is needed to assess that.
Thank you, Natalie. We have a question from Mr. Gerard Mendez. Are financial audit firms and their associations being advised on the requirements for the upgrading, auditing of their intermediary customers?
So our process is always to engage with all stakeholder groups. So where there are any changes in requirements, we always engage with the related stakeholder groups. So when there were changes with the capital adequacy, we engage with the actuaries, we engage with the Urban Actuarial Association, etc. In similar manner, we are engaging with relation to the auditing firms. The central bank does have a periodic meeting with ICAT to discuss these as among other things, right? So to answer Mr. Mendes' question, the answer is yes, we are engaging in relation to the new requirements for the audited financial statements for intermediaries.
Thank you, Naveen. Amit Misra asks, in view of the economic challenges being faced, particularly in light of current COVID situation, how is the aspect of premium payment by policyholders going to be dealt with?
So I'll start with that. I'm not sure I understand the question in entirety. So I'll start with some observations in relation to what we have been seeing. And this is not something specific to insurance. Since the advent of COVID, we noted a big migration in relation to online payments or the utilization of electronic type payments. So where persons used to write checks and give their agents and brokers cash, we now see a lot of more e-commerce as opposed to the cash and check transactions. We also noted that many insurance companies and intermediaries have upgraded their online presence to facilitate these types of payments also. So I hope I answered the person's question.
In addition, they continue to be physically open in terms of their premises and observing social distancing requirements. So that's another avenue that we've been seeing. So online as well as physical, adjusting their office to receive the money physically.
Thank you. Question from Jeffrey Dalton Brown. It's a two-part question. What is the time frame for CBTT to issue further guidance on the alternate dispute resolution scheme? And he asks again, what is the difference between CPD hours and CPD credits?
You did.
So I'll deal with the easier question first. There's no difference between CPD hours and CPD credits, right? As 12 CPD hours per annum. So as I kind of mentioned before, we are working with the industry to determine what does that mean. It may mean that a seminar such as this may only qualify for one CPD hour. So again, those guidelines will come out hopefully sometime soon. But again, we are working with the industry in relation to this. The first question, the alternative. So the answer to that is soon. I can't give you a date in relation to when exactly it will come out, but again, we have been engaging with the industry in relation to this requirement, and hopefully that guidance will come out in the near future.
What I could say as well is that we have a time limit for implementation. I think it's within 6 months of the proclamation of the act. So we will send information on a timely basis for you to determine what is your course of action going forward.
Thank you. Ms. Avian Ferguson asks.
Let me make a correction. The ADR is within 60 business days, not 6 months. We'll be speaking to it. We'll be releasing the information soon.
Okay, thank you, Mr. Solomon. So the question from Ms. Ferguson is, please explain the transition process away from the statutory fund. Is it that it will be released when an insurer submits its capital plan?
Okay. The statutory fund, once the act has been proclaimed, so the statutory fund no longer exists. We will be sending out a circular letter to that effect, so the insurers can request the releases of the assets from the statutory fund. It's not dependent, the release is not going to be dependent on whether a plan is submitted or not.
Okay, thank you. Gina Samaru asks, the CBTT surely recognizes that there's substantial cost to the improvements, capital requirements, CPD, and additional regulatory best practice requirements. This cost will have to be passed on by the insurer to the policyholders. I guess it's more of a statement than a question.
Okay, what I could say is what Gina has just described is the cost of doing business. So they have to cater for that in terms of the revenue they collected and offset the costs against those. But anyway, the decision is for the company to make because you have to comply with the act and you have to make your business as efficient as possible. The purpose of the act was to strengthen the insurance company, and if there's a cost associated with that, you have to bear the cost associated.
I just want to add to that statement by the inspector, just to inform the listening public also that these requirements being introduced in the new Insurance Act are actually requirements that have been introduced with our regional counterparts for many, many years now. So it's not something that is foreign, it's something that exists throughout the Caribbean and in most developed countries.
Thank you. From Nicole Joseph, any comments on taxation of long-term insurance business?
Could you provide some more clarification on the question? From what aspect are you asking this?
Okay, while we wait on Ms. Joseph to clarify, we have Amit Misra again. To clarify the question, well, with regard to register to be kept as under Section 270, does Central Bank have any time period in mind up to which the record is to be kept?
Okay, the companies are required to maintain the register in accordance with the requirements of the Act. They can liaise with their legal department or legal persons in terms of how long they need to maintain that register, what is the statutory requirements with regards to that. But we would expect, though, that at any time they have a register of all current persons or all current policyholders that are on their books. No specific requirements has been outlined as yet, but the bank will consider and issue any guidance in future on this matter.
Thank you, Natalie. Ms. Gina Samaru asks, there is considerable confusion among the brokers as to exactly whom in the brokerage is required to do CPD. Is it just the broker and sales representatives, or is it all staff who might interact with the public? What does the law demand?
So I will answer the question in relation to the brokerage. However, this is also translated. The same answer can be translated for agencies. So before we get into the CPD discussion, let's talk about the brokerage structure in the new law. A brokerage can have with it or registered with it a broker or more than one broker in addition to sales representatives. So anyone that is soliciting or is dealing with the public in the selling of the business, they are required to be registered as some form of intermediary, either a broker or a sales representative in relation to the brokerage framework. those persons are required to get the CPD credits for in terms of the 12 hours per annum. Other staff are not required to. Yeah, and again, it changes, or it is varied from one brokerage to the next. Yep.
Thank you. Mr. Earl Harry, his question is, can we now expect to see the role of the central bank charging changing somewhat to include direct auditing of insurance companies to ensure corporate governance along the lines of items identified?
A specific audit in respect of that may not be required unless there is some particular issue. The bank do conduct its on-site examinations, and when we conduct our on-site examinations, corporate governance is one of the aspects that we will be looking at to ensure that there are adequate policies and procedures in place, and the company itself is following their own established procedures.
Thank you. Thank you, Natalie. Question again from Samantha Saw. Section 92 prohibits an insurer from acquiring shares of its holding company. For companies that have to unwind such exposures due to acquisition, what is the timeline by which this must be done?
There is a transitionary period that will be allowed. The bank will liaise with the companies on a case-by-case basis to determine what are the issues involved and what are the risks. Connected party exposures are 3 to 5 years according to the transitionary period.
Thank you. Question from Gina Samaru. The new act calls for less liquidity to be extended to policyholders, read timeframes in which they can make premium payments. Given the COVID economic environment, the depressed economy, does the CBTT expect a considerable de-risking within Trinidad?
All right, that is an interesting question. When we look at the act speaks about granting of credit. And under the old act, the insurance company had 45, you can give credit to general insurers. And that period was 45 calendar days. Under the new act, it is now 20 business days, which is equivalent to 1 month. To be forewarned is to be forearmed. This is a new environment that you are operating in. So therefore, you need to advise your clients that there are different alternatives available. Premium financing may be one of the alternatives, but these are the rules that we have to comply with. So you have to recognize that if you think insurance is necessary to protect your assets, you'll make the necessary arrangements. And I'm thinking that the insurance companies are complying with that. And I guess as brokers, you need to advise your customers appropriately.
Thank you. Question from Leslie Ramcharitar. The reports of the auditors required under section 147(1) and 147(2). Will guidelines or templates be provided?
The reports from the auditors would be the insurance reporting requirements are consistent with the IFRS standards. So the auditors' reports will be consistent with their standards also in terms of the audited accounts. So it's not it's not necessary at this time for guidelines or templates to be issued to the auditors.
Thank you. Leslie Ramcharita follows with, has CBTT and ICAT agreed to the requirements for the publishing of abridged financial statements?
We are not, we are liaising with ICAT on this, and it's not completed yet. We are working on it, and once it's completed, the requisite circular letters and guidelines will be issued to the industry.
Thank you. At this time, I'd like to read a message that came in from Ms. Catherine Kumar. Firstly, let me congratulate the Central Bank of Trinidad and Tobago on achieving this milestone, which has been long in coming. I am aware that a lot of work has been done already by the Central Bank with the industry, but we know that a lot more has to be done to bring the full industry, especially the general insurance companies, into full continuous compliance, with the accent being on continuous. The major challenge is keeping the Act and regulations in line with current prudent international regulatory practices. Having to go back to Parliament to achieve this on a regular basis is not the most effective way, but understood. What are the central bank's plans to keep legislation updated and not have a repeat of 1980 Insurance Act still in operation in 2020, some 40 years later?
Thank you, former Inspector. We still have a lot of leeway in terms of issuing guidelines. And we use guidelines based on principle base. And we continue to evaluate the Act against the international best practices. And we will continue to issue circulars. We'll continue to have feedback from the industry and issue guidance. We may have to, if some of the requirements are not fulfilled, the Act gives us other ways of ensuring compliance, like issuing compliance directives. But we wouldn't want to use that as the first course. We would want to continually look and see what is happening in the industry compared to our practices and see how best we could move to the internationally accepted standards. What I need to say is that a lot of the companies have already gone beyond these minimum standards that we are speaking about today, right? For example, in terms of capital requirements, they have much more capital than the Act specifies. They have market conduct arrangements in place so that they treat customer fairly from the beginning to the end. So this Act is a nice Act which gives a lot of room for collaboration. So what we have done to share information, we have established a forum, which we call a forum, whereby questions could be sent in to the central bank, and these will be published to all the insurers, get their views, and then we'll give a final position. So we are thinking of being proactive and working with the industry to achieve relevance.
Thank you, Mr. Solomon. We will now take our final two questions. Remember, if your question on the new Insurance Act and you was not addressed at this forum today, we invite you to send these questions to us via email, info.central-bank.org.tt, and we will be happy to continue the conversation offline. We have a question from Mr. Chapman, Mr. Javon Chapman. Would the Insurance Act take into consideration the time frame to remit claim settlement checks to customers after settlements are agreed between the claimant and the insurer?
So, excellent question. The Insurance Act does have a timeline that's hard-coded in relation to that exact question. So I believe it's could be wrong, but I think it's 10 days from when the company decides that the claim is legitimate for the check to be remitted or to be paid to the client. So the answer to the question is yes, it does.
There are also some timelines in section 134 and 135 of the Act that should be met. There's another area that will provide some clarification.
Thank you.
If I may, I just want to come back to the question regarding the corporation tax for long-term insurers. There were some amendments to the Corporation Tax Act, and any further questions on this can be directed to the BIR because they will be responsible for those sorts of amendments.
Okay, thank you, Ms. Ruchansing. We have a question. Our final question comes from Kyle Rudden. The Act introduces fees for late pension plan audits and actuarial validation reports. How will this be applied for audits and valuations that are already overdue? Would time be counted from January 1st, 2021, or would it apply to items due in 2021?
So I thought I would get away with not answering any pension questions, but good question, Kyle. We are working internally to produce those guidelines. Okay, so hopefully sometime soon, we will advise the industry in relation to that. That being said, as Kyle would know, we have taken a very collaborative approach in relation to how we address non-compliance issues on the pension side. And through that collaborative approach and hard work from the industry practitioners, that compliance rate has improved significantly over the years. So I know it's not directly answering Kyle's question in terms of when, but we will issue guidelines in relation to that transition.
Thank you, Naveen. Now, I know we did not get to all of your questions, but please, we invite you all, we ask you all to send them in to us, again, via info@central-bank.org.tt, and we will provide you with that feedback. Right, we will also prepare a FAQ document that we can share via our website. We thank you for your questions. We thank you for spending the time with us this morning. And we trust that you now have an understanding of the main characteristics of the recently proclaimed Insurance Act. Note that a recording of the webinar would be made available via our website, Facebook, and YouTube channels. You can also view the presentation, the PowerPoint presentation there as well. From members of the panel and all of us here at the Central Bank, we encourage you to continue following the established health protocols to stay safe, keep well, and do enjoy the rest of your day. Goodbye.